Nothing hurts worse than getting stopped out of a trade just before it finally goes the way you thought. And you're left wondering, am I just unlucky? Well, I've realized it's usually not just bad timing. The big banks and hedge funds actually know how to bait normal traders like us into buying or selling at exactly the wrong moments. They use specific tactics to lure us into stops, scoop up our positions, and then flip the market to continue the move. It feels unfair, but what I will teach you today will save you a lot of bad trades. Something I was shocked to learn is that markets are actually way easier for big players to control than we realize. See, while it seems random to us, in reality, price action follows what a smaller group does, the so-called smart money. These are the huge banks, hedge funds, and dealers that make the market, because they see all the buy and sell orders coming in before anyone else. They have way more power over where price will move short term. Once you accept this reality, it totally changes how you trade. Instead of fighting them, you need to learn to predict what those big players might do next based on specific clues. So the market may look random, but truth is, just a handful of pros control short-term price flows. Those big players have ways of manipulating markets that normal people like us just can't compete with. For one, they can see every single stop-loss order placed, just waiting to be triggered. Just imagine filling a huge order, then taking all the stops below for a nice profit. They also have insider info before headlines even appear. The little guys like us never hear whispers from the top. Plus, with their order volumes, they can subtly move price up or down to fill buy and sells without moving the market against themselves. Elite tactics we don't have access to. When you realize how much they can see behind the curtain, it's silly competing with the smart money directly. While we're busy day trading pennies, they work on a much bigger scale, from quick flips to longer term positioning. So, how do we find out the intentions of smart money? Now let's be real, we cannot know what they'll do in the future, but they do leave hints for us in volume and price action. Volume shows us how heavily traded a market really is, while the actual price spread, the difference between the open and the close, reveals if they aim to go long or short based on that activity. But here's where it gets sneaky. The big boys will do things to tip the odds more in their favor, like gapping up overnight to stop people out, shakeouts to scare people into sells, and price tests to flush weak hands. After reading several books about these big players, I realized that watching volume is key to reading what they actually intend to do. Remember, those whales have the power to manipulate trends over time with their enormous positions. When a lot of volume kicks in during a move, you know the smart money is getting seriously involved and likely intends to continue forcing that direction. Their collective action is what shifts markets in the long run. But just as important is when volume totally dries up during an up move, because that's a sign they aren't actually not backing the upswing. Known as a no demand, low volume rallies are doomed to fail once they lose the smart money support. Normal traders like us opening positions have zero impact on the market flow. So pay attention to volume surges and volume fades, because this is how you read what the big boys are doing. And it's unreal how the smart money exploits human psychology like they do. The big boys know how most traders are torn between FOMO and fear, and they twist that to their advantage so smoothly. Whenever a big news is released, smart money always has an angle. And this is why you'll see instances where an economic report is released. The news are good, the market should go up, but instead it decreases aggressively. It's a classic shakeout move. The buyers who thought they were being smart are now getting trapped. Smart money also like to trap sellers during these moves, cashing in both ways. While we battle emotions, these pros know exactly what they're doing. so they profit no matter what. The only solution is accepting we can't beat them. We got to understand their moves and try to follow their steps, their lead, instead of trying to outsmart them. There's more to trading than just looking at the price action. See, what the big traders really don't want us to pay attention to is the volume. When you look at just the price, it can make you feel nervous or excited. But volume gives you the real facts of what's going on. No matter what market you look at, they all work basically the same. And the more people who are buying and selling a particular market, the harder it is for anyone to easily control it and change the price however they want. But with thinner markets, where not as many orders are happening, it's easier for big players to manipulate things. You'll definitely see big players trying to sway prices when trading is low. But don't forget, they need opportunities to make their moves too. Things like news that causes uncertainty, or times with less buyers and sellers around, that's when they pounce. As much as we don't want to admit it, people have a natural tendency to just go with the crowd, and the media knows how to use that to their advantage. Whether it's talking about stocks, crypto, or whatever, if a bunch of news sites or shows all say the same thing about an investment, most people will believe it without question. But what if they're wrong? Then the herd gets hurt because they followed bad advice. The thing is, smart money sees right through us. They know just how to steer public opinion to serve their own interests instead of ours. They realize fear and greed control us more than we'd ever admit. And that's how they end up winning, while retail players lose money. The lesson is simple. You really have to start thinking for yourself, and not just following the pack, if you want a fair chance at the market. And I know it's tempting to just want trading strategies and tips without understanding the context behind why certain techniques actually work. But hear me out. Understanding how big money operates is the key to succeeding long term. Otherwise, you're just gambling blindly without the full picture. I was, and I still am sometimes, when I start to trade emotionally. But once I began dissecting what patterns keep emerging, it all started clicking into place. Like sharp drops below clear support levels, just enough to trigger everyone else's stops before it rebounds as planned. You know them so well. You lost a lot of trades this way, didn't you? We all see these tricks playing out over and over. So unless we accept smart money knows psychology better than we do, we'll never stop getting fooled. Only in this context, specific strategies like volume spread analysis really shine. It reveals their tactics in real time versus getting played reactively. I used to think it was my broker messing with me when my trades would go bad, but that's not really what's happening. Unless you're using some shady offshore broker, they probably aren't doing anything sneaky. The real ones triggering all those stop losses are the smart money. You see, those huge hedge funds and banks can't just jump into the market all at once. That would move the price too much against them. What they need is liquidity, which means being able to build positions gradually without affecting the market. And that's where our stop losses come in. They give the big players a perfect way to find good prices without causing a spike. Let's say you trade stocks. Every time one of their trades triggers a bunch of stops, those shares flood back into the market for the big boys to pick them up. So we little guys aren't the targets. Our stops just provide the liquidity the smart money requires. And I used to think some of those classic trading rules were a sure thing, like waiting for the perfect setups at obvious support levels. But after getting caught out a few times, I realized there's probably more to the story. If every trader is trying to buy at the exact same price point, like a major technical support level, who are they actually buying it from? It got me thinking, if the big institutions know everyone is watching the same levels, Don't they have an incentive to manipulate prices a bit to find sellers? Why wouldn't they try to trick the average traders like us into selling just before completing the bounce we were all hoping for? Now it makes perfect sense why textbook levels get breached so often. Smart money will bend prices exactly where they need for maximum liquidity grabs, masked as breakouts. We are acting as liquidity. Every time I see smart money pull a sneaky fake out below or above a level, it makes total sense in hindsight. But in the moment, isn't so convincing. They know we target trendline breakouts, bounces of support, so price suddenly pierces right through it, like the level meant nothing. And of course, that scares weak hands into panic selling breakouts. Meanwhile, the big banks are scooping up our dumped positions below the supposed break because they arranged the whole thing. Textbook liquidity grab. Then, to really rub salt into the wound, price reverses perfectly back above it, just like we planned from the start. The only difference is they played us to sell the bottom. It's so slick how they manipulate stuff to shake out one side, provide the other, then reverse to collect winners both ways. And we're left scratching our heads why good trades never work out. These pros truly know psychology is the name of the game. When a stock clearly has a big support coming at $10, but starts wobbling around at $10.50 first, you know the pros are setting their trap already. Because as soon as it ticks up a few cents, FOMO takes over weak hands. What if price never gets to $10? I should buy now before it takes off. Retail traders just can't stand the idea of missing potential gains, so they jump the gun, buying the early bounce, playing right into the smart money's cards, as expected. Then comes the fun part, where they start the actual shakeout. A few well-timed breaks below support have panic sellers transforming their long positions into losses, just in time for the big players to pick up their shares at a true discount. Rinse and repeat every single time. This is the classic pre-support shakeout trap. So is manipulation good or bad? Honestly, both. If we keep getting played by their tricks, then obviously that sucks. But once you learn to decode charts using volume spread analysis, manipulation becomes more of an opportunity than a threat. I know it's easy to consider the smart money as the bad guys, but really, they're not evil or trying to straight up steal your cash. We have to understand these huge companies are in the business of making money. They've spent a long time learning how normal people behave in markets, as well as how markets move overall. To them, trading isn't personal, it's a game they've mastered. With their massive funds and top-notch research teams, big firms clearly have way more info and power than regular traders. They are simply capitalizing on situations to their benefit, just like we are trying to do. You can't really blame them for that. It would be dumb not to leverage their upper hand. Think about it. Wouldn't you want to scoop up stocks for pennies before pushing them way higher? You can't really hate the player, hate the game. So what are the strategies we can use to align with the smart money at their own liquidity hustles? First, learn to trade counter to the crowd. Look for opportunities where most retail traders are positioned one way and try to time your entry in the opposite direction once you spot institutional activity. This allows you to benefit from any manipulative moves against the herd. How do you spot institutional activity? Use volume analysis for buying and selling signs. Pay close attention to volume spikes and other volume signs to identify where smart money is accumulating or distributing shares. Trade with them, not against them. Third, set stops outside of obvious levels. Don't place stops right on major support or resistance levels, as this invites manipulation. Leave some buffer room to avoid stop runs, and focus on big volume markets. These are harder for big players to manipulate, And always be on the lookout for liquidity grabs. Watch for sudden moves that trigger stops, then reversals that benefit those who sold into the stop run, and trade against these fakeouts. These videos will explain more about these strategies.